Hi everyone, I'm the CIO of Binary Capital, Saftar, Sarwar. So it's a pleasure to have Tom Slater of Baillie Gifford with us today. By way of background, this is our kind of podcast CIO podcast series where we try and spend some time, some leading thinkers in the investment industry, trying to understand as much as we can, and for our audience, what's happening in investments, markets, trends, and so on. So as I said, it's my pleasure to have Tom with us. Tom has a very credible, long-standing career at Baillie Gifford, having started, I think you did an undergrad degree, computer science and maths in
Yes.
Edinburgh, a city I know really well, and then been with Baillie Gifford ever since in many departments. Now lead their Scottish Mortgage, lead managing the Scottish Mortgage Investment Trust, as well as the US team, as well as spending quite a bit of time on the private capital team as well, as I understand. And it's quite interesting, as I said, pleasure to have Tom having some time with us. Recently, the Times said, described Tom as the man who made billions for Brits by betting on SpaceX. So that was one of the headlines over the summer, I think just after or prior to SpaceX going public. So maybe Tom, to start off with, maybe give us a sense of you as a person. You studied computer science and maths, very different from investments, economics, finance. Tell me more about that, and why investment management, portfolio management, and why Baillie Gifford as well?
Well, thank you for having me. It's great to be here. As you said, I joined Baillie Gifford straight out of university, so in 2000, just past the peak of the dot-com bubble, and I've been there 26 years, just about ever since. Why did I get into investment? I don't know. I think it's probably a sufficiently obscure career that very few people grow up thinking, I want to become a fund manager. But I think, coming from that computer science and maths background, there was a lot of people going into .com type companies at that time. I was more interested in trying to work out why some succeeded and some failed, and that was the sort of analytical aspect of it that interested me. And then a friend of a friend had joined Baillie Gifford the year before, and I think back at that time, there were graduate recruitment firms, programs at a lot of the big investment management firms. But almost the first stage of the Baillie Gifford selection process was that you had to have heard of Baillie Gifford. It was a much smaller firm, much lower profile in that day, and it did not go out of its way to make itself high profile. So I think you had to sort of have sniffed around the investment management industry and to sort of come across it. And then what attracted me to it was whereas a lot of firms would have these sort of elaborate selection days. You've been dropped in a desert with your team of 6 and try and put the items in order. It was just much more sort of down to earth and personal. CV covering letter, come and talk about what you're doing, why you're interested, a genuine interest at a personal level that sort of drew me in. And then I started on our Asia Pacific desk, as it was then, as all of our trainees do, rotated around some different teams into the UK equity desk. And then I joined the Scottish Mortgage team as the deputy manager in 2009, and then sort of been part of the management team for the past 17 years.
Wonderful. And in that period, Tom, 25 years, long time period, a quarter of a century of one firm, one career. What's really shaped your thinking, your philosophy, your ideas? Has it been the people? Obviously James Anderson, very, very high profile investor, probably one of the key investors of his generation that you work very closely with. What's kind of shaped your thinking as you sit here today in 2026 as a major investor in the UK and probably European landscape?
I think it's been a few things. When I would go back to maybe sort of 2008, 2009, and I went and did some extended trips to the west coast of the US. We had big investments in Amazon and Google around about that time. And we're trying to both get closer to that technology ecosystem, but also understand what was happening in the private sphere and some of the private companies that were coming through. And so I think those trips were pretty formative for me. Apart from anything else, just a completely different approach and attitude to risk and opportunity that exists on the west coast of America as say compared to the UK. Met some brilliant business leaders, met some brilliant investors on the private side who had shepherded some of these companies through their formative years, and I think that shaped a lot of my thinking about where growth might come from over the next decade or two. I think then in parallel, I'd say spending time in China. We'd invested in the likes of Baidu, the search engine, Tencent, the social media company, and I've been lucky enough to work with some great Chinese colleagues who were able to really help me see a side of China that it's often quite hard for a foreigner to do. And I think some of the numbers that, if you go back to that time, some of these numbers that were coming out of these companies just looked ridiculous. And actually understanding that these growth rates, the scale of what was happening was real. And I think was really helpful to me in evaluating later opportunities that came through. You can go into that if you're interested. But so I think spending time in those two areas has been really important for me. As you alluded to, some of the people, the partners at Baillie Gifford that I've worked with, I think we're one of the very few unlimited liability private partnerships left in the investment world globally. And one consequence of that is that partners tend to stay and work in the firm for long periods of time. I've been there 26 years, but I'm not unusual in that respect. Yeah. And obviously James was very influential, and we worked together for a long period of time and crafted the investment philosophy of Scottish Mortgage as it exists today. But there have been others across all parts of the firm, and I think that partnership structure and that collaborating closely with senior investors is a really important part of the integrity of the investment process at the firm. There's a certain sense in which this is the best job in the world, because you get to spend time with the people who are building the future of the economy. And because of our investment approach, which is to be very long-term in everything we do, to try and evaluate companies, over decades, not quarters, try and get away from that game that most of the market is playing about guessing what the earnings will be in the next 12 weeks, that we've been able to build proper relationships with some of these leaders, and they're geniuses. I'm certainly not a genius, but get whether it's Bezos or Musk or on some of the private founders like Pony Ma. I think being able to just absorb some of that wisdom, some of that thinking, and bring it back into your own investment process has been a really important source of alpha.
Obviously there's a lot of investors classify themselves in various categories. Tom, do you see yourself very much as a growth investor? And if you are, or how do you see yourself, and what does that mean to you in the way that you invest going forward?
One thing I would observe is that if you have the type of time horizon that we have, then what you see is a power law distribution of returns in stock markets. And what I mean by that is that a very small number of companies contribute an outsized proportion of returns. And so that frames the job for me as trying to identify companies that have the potential to be one of that small number of companies, that have an opportunity that's big enough that they could be one of those outliers, and then to try and hold them for long enough. Now, for me, the way that's manifested is being a growth investor. It's trying to identify the companies whose revenues, whose sales could be a lot bigger 5 or 10 years from today, and where that opportunity isn't appreciated. That's of course not the only way to be long term, but for me, as a way of taking advantage of that structure of stock markets that comes over the long term, it has been about thinking just how big a big company could become, how great a great business could become. The archetypal example for us is Amazon, which we bought in 2004, still a big holding in the Scottish mortgage portfolio today. At the time, you would have said that was an online bookseller. And obviously the opportunity has continued to expand and expand and expand. And where you can find a company that has that type of profile, I think that's where you can generate supernormal returns.
Mm-hmm. And in that context, Tom, I'm really interested in this from a behavioural point of view, or resilience. How do you frame your thinking or your team's thinking around when you have drawdowns? Because as you know, being a growth investor, or being any investor, but certainly a growth investor, there are periods of significant drawdowns. Even this year, for example, Scottish Mortgage, the investment trust you lead, performed really well up until the summer. Then they had a bit of a drawdown during June and July, and now it's popped back up again this month. So significant percentage falls, minus 15%, plus 8% in short periods of time. How do you manage that from a behavioural, psychological point of view, knowing you manage a lot of capital for retail as well as institutional investors?
Yep.
And how does it make you a better investor, how you kind of manifest itself around that?
Well, I think the starting point has to be that you're really clear with people about how you're going about this task. There are plenty of black boxes approaches to investment out there, but what's really important to us is being as open as we can be about what our process is, how we go about the task and what the trade-offs are from that. So we're trying to, for our shareholders, we're trying to deliver long-run capital appreciation by investing in high-growth companies. But one of the consequences of that is volatility. And so if seeing volatility in the stock price is something that you find difficult, then Scottish Mortgage isn't for you. And I think just being upfront with people about that and saying, look, these are the type of the companies we own. We want to give you as much transparency about the types of things that we own. We want to give you an understanding of why we own them. And then you can decide for yourself. Do you like these type of companies? Do you agree with this approach?
Yeah.
And can you cope with the volatility? So you're absolutely right in the observation that we do deliver a volatile ride for our shareholders, and we don't try to manage that volatility. Now, one of the reasons for that is that if you look at the big winners in the portfolio over the past 20 years, and this applies more broadly across the market as well, that all of those big winners, without exception, have had a period where they've been really out of favour, and you've seen big falls in the stock price. And a really important part of delivering the subsequent return has been able to endure those periods. Now, some people might be really smart and able to sell before you have these drawdowns and buy back at the bottom, but that requires you to make two really good decisions. And our approach is slightly different, which is that if we see no change in the reasons that we own a company, we just endure owning through those more difficult periods, because we think that the eventual returns will more than offset those more difficult periods. A great example would be Nvidia, by far the world's largest company today. Now, we've owned it since 2016, but in 2022 it fell more than 70%. Now, if you couldn't live with that volatility and you sold the shares, then you would have missed out on making many, many times your money since 2022. That return was only available to the long-term investor who could live through that drawdown.
And in that example, Tom, it fell 70% during that period. How do you manage that mentally when you're going home every week, month, knowing that there's been that drawdown in that position, but you still want to hold on to it, even maybe add to it? You still have that conviction approach to it.
Well, I think it's being really clear about why you own a stock.
Yeah.
And so you're evaluating the news flow and the reasons it's going down in the context. Does this change why I own this company? I think there's a helpful point from the process. The reason I go back to being really clear with people is, if you go back to 2022, which was a really difficult period for us, we didn't have a lot of people, shareholders banging down the door saying, this isn't what I signed up for, what are you doing? It was, well, we understand that growth is out of favor. We understand that you guys are more growthy than most, and that that you've been upfront. So I wasn't coming under pressure from shareholders as we went through that more difficult period, and I think that's really important. And to be clear, I have a very significant part of my personal wealth tied up in the shares, so I'm going through that difficult that period too. But I think it's just back to this belief that it is inevitable that you will go through those periods if you want to make that long-term capital appreciation. It's not an unfortunate incident. It's an intrinsic feature of long-run growth investing, and that's why a lot of people say they're long-term, but when you actually look at the numbers, they're not long-term. It's because it's a pretty lonely place sometimes, and it's a pretty difficult place to be. It's not glamorous.
Yeah, we've had more evidence even this year. I'm going to touch on this later on in our conversation about active, passive, but some in the active investment houses pivoting. We've got a large investment house, again, long-term quality growth manager who's pivoting towards more or saying, do not hold forever, to now we're going to follow momentum as a philosophy. So, people are changing, and there's evidence. Again, we speak to obviously buy-side guys all the time saying, look, going forward, there's going to be more turnover, potentially the market will demand more turnover in portfolios to generate alpha around that. Do you have a view on that in terms of turnover, people pivoting away from their core strategy based on what's going on just now?
Yeah, well, I think it's been a very, very difficult environment for active managers. Maybe just double check these numbers, but in roughly, if you take the Russell 1000 Growth Index, the index, the biggest index of growth companies in the US, it's done about 18% per annum for a decade. It's delivered a phenomenal return, and it's been very difficult for active managers to keep up with that, because at the same time as it's done that, it's become more and more concentrated in a smaller number of companies. It's not a diversified measure of the market anymore. It's a concentrated bet on a small number of companies, and actually to meet the diversification requirements, you can't even own the index.
Yeah.
So that's been it's been a very difficult environment, and at the same time, you've seen the market become much, much more volatile. I met the CEO of NASDAQ fairly recently, and I asked her about this, and she agreed. It's just it's some combination of the growth of passive investing, the much higher levels of participation from retail and stock markets, highly leveraged hedge funds trading, that you get much sharper stock price reactions, and therefore being an active manager can feel more risky. There's a lot more threat to your business if you're delivering an outcome which is very different from the index. So I think it's completely understandable, the pressures that come from that. I would observe, if you go back to 2003, 2004, we'd gone through the dot-com bust, and you had active managers going to their clients and saying, look, I've outperformed the index. I've only lost half of your money. And clients are saying, well, I don't want this. So, I want my active managers to give me a completely different exposure to the index. And I see that's today is the absolute reverse of that. And, I think over time these things change and even themselves out. It is a response to a specific market environment that we're in. So, I don't think it's easy at all. For us, it's about sticking to our guns, that we think what we have an edge in is taking a long-term view. There are lots of people trying to predict the short run, and we don't have any edge in that. Buffett talks about the idea of a circle of competence. I think it's really important as an investor to think about what it is that you do that's different from others, because you're not going to get a different outcome if you don't do something different. And for us, it's being resolutely long-term in the face of all of these pressures.
I liked that, Tom. You touched on it earlier around the kind of trying to invest in the key outlier stocks that produce those exponential significant returns. Obviously, there's a lot of research around it. Hendrik, Bessembinder, that you guys cite a lot, Baillie Gifford cites a lot around that I think it's less than 4% of companies in his research create most of the value in equity returns historically. And even more recent research around kind of buy and hold, that one should, if you want to capture returns, just buy and hold a S&P equal-weighted position away from market cap weighted and so on. I want to understand that. So that's interesting research which you guys cite, clearly used in your portfolios, Scottish Mortgage, interesting outliers. I'm sure we'll touch on that. So that's academic. How easy is that to actually implement in practice and do really well to capture these kind of needle in the haystack kind of scenarios, as opposed to, like a lot of passive guys tell us, might as well just buy the haystack.
Yep.
Vanguard say a lot around this. Just buy the haystack, guys. It's impossible to do this side of the trade.
I think that investing passively is a very reasonable and sensible thing to do. And one of the principal reasons for that is it's such low cost way to invest your money. I think if you're going to invest in an active strategy, you want to keep your costs to a minimum as a starting point, because that bit is inevitable. You'll pay the costs regardless. And then you want to get a genuinely different exposure to the index for your money. Now, for us, and how you come to that genuinely different exposure, there are lots of ways to do that, and it comes back to this: well, what do you think your edge is, and what can you do differently that's hard for other people to do? For us, it's back to time horizon. That we think we can be really patient, in an industry which is ever more impatient, and then it's as you say, if you really believe that stock markets are driven by a small number of big winners, you need a process that's oriented about finding those. It's not about covering every stock and every earnings announcement, but it's your process has to be oriented about uncovering those companies that have that opportunity to become much, much larger than they are today. And that's difficult enough in itself. But the second one is you've got to hold on to them for long enough that share price return accrues in your portfolio. And that's partly what we talked about before, about not getting scared out of these long run winners at low points in their share prices. But it's also not thinking that just because a stock has become a larger part of the portfolio, it has, for some sense, become more risky. So I think about it as scale of the opportunity and likelihood of capitalizing. And so if I own a stock and it's doubled, well, I ask the question, well, has its opportunity doubled? Or has the likelihood of it capitalizing on that opportunity doubled? And if that's the case, then I can remain a comfortable owner of that business, even though it's larger. And a great example of that in the portfolio today that you mentioned earlier is SpaceX. Yeah. We bought that back in 2018. And as I looked at that business, it felt like they had a number of opportunities that can make it a lot bigger than it was then. That was partly in launch, but then it's partly, if you can get launch working, what opportunities that create. We've seen that in Starlink, the satellite broadband business, but there were other opportunities. Could you have manufacturing in space? Could you have space tourism? These were questions that we were asking back in 2018. Yeah. But it seemed to us that we could confidently answer the question: are there big enough opportunities for this company to be a real winner? And then we looked at the structure of the market, and there were relatively few commercial launch companies at that time. So we thought, well, it looks like the market structure could allow them to be a winner. And so how have we managed to hold on to it and to the point where it's become a very big part of the portfolio at the time of the IPO? It's because that opportunity has just kept getting bigger and bigger, and we've seen satellite internet grow and become something really serious. And we can talk about the future and whether you can have data centers in space and so forth. And at the same time, the likelihood of them capitalizing kept going up and up because they were executing, they were launching the rockets, learning, bringing those rockets back, getting the data, increasing the safety record. And nobody else in the commercial sphere was actually getting their rockets into space. So the opportunity was getting bigger and the likelihood of capitalizing was getting bigger. And that's what allowed us to run that position to the point where it created billions and billions of dollars of wealth.
Tom, you're saying you could, as that position was developing and as you were getting closer to management, you could see that opportunities which others didn't see. Nobody had, clearly some other funds in the UK had SpaceX, but not to the same extent that you guys run with it.
Well, I mean, partly the issue was it was a private company back then, and private companies, having a mix of public and private companies is not something that a lot of people have the skill sets to do. The world tends to be divided into investors who are specialists in public companies and investors who are specialists in private companies. And what we've done with Scottish Mortgage is try to bring that together and say we just want the best growth companies. Let us worry about whether they're private or public and the technicalities of implementing that. But first and foremost, let's just find the best companies. And then I think the second part of it was, we invested in Tesla back in 2013. And so we knew Elon, we knew his approach to managing companies. And more importantly, private companies get to choose their own investors. Which is very different from investing in the public markets. And so, I think the way that you invest and your reputation becomes so much more important. And we were able to go to him and say, we'd like the opportunity to invest in SpaceX, at a point where he could say, well, I can see that this investment team have held my shares for 5 years. They're not speculators, they're serious investors, and they try to engage on the fundamental issues. And therefore, I'm prepared to give them the opportunity to buy some SpaceX stock. And for others, that wasn't necessarily an opportunity that was there. So, there were some serious, we had some proper debates internally about first of all, how big is the opportunity? How capital intensive will it be? How much competition? It wasn't obvious, but the guiding light was back to, well, if we're right, is the opportunity big enough to make a lot of money? And that was the piece that we had conviction in.
Now, obviously SpaceX has circa roughly about 25% of Scottish Mortgage's overall holdings, Tom. Clearly that might change as the lockup expires going forward. Clearly significant position there. That doesn't concern you just now, that you've got such a large almost like correlated position to what's happening with the SpaceX share price every day.
Yeah. So
how do you live with that?
So we're about 20% and in SpaceX, and that is an unusually large position for us. I do think as somebody evaluating Scottish Mortgage as a prospective investment, they have to be mindful of that at the moment. I think it almost requires a view on SpaceX as well as the rest of the portfolio. We have to make the investment decision based on what's in front of us. What is the valuation? What are the other opportunity sets? But the expectation over time is that we wouldn't have this degree of concentration in a single stock. It's arisen because the value of the company has grown so much, and then as a private company, and then it listed on the stock market earlier this year. And if you're an existing investor in the company when it's private, you aren't then typically allowed to go out to sell your shares. You have what you mentioned. You have a lockup, so it determines the time scale. And basically, what it means is that over the 6 months from the time of listing, we'll have opportunities to sell down our holding. And we will over time make those decisions based on the opportunity set, but investors should expect over time that degree of concentration in a single stock will come back down to within the historic ranges. Yeah, makes sense,
Tom. I want to touch on that, Tom, kind of go into the kind of second half of our discussion around something you kind of touched on when you were at a conference a couple of months ago in London. I want to kind of bring this kind of theme out around whole kind of technology, AI, the whole kind of tech stack. Even this year, we've seen this move away from software to hardware, kind of pivot. You talked a lot about, Tom, I think it was something about kind of anticipation era going forward, similar to what we saw, was it 2005, the kind of mobile era to 2015? Can you articulate that a bit more? Maybe non-jargon terms to others. Even I was a bit flummoxed with it as well, perhaps.
Right, okay. I will have a go. So I actually stole this from Spotify. So I was meeting the team that runs Spotify, Alex and Gustav, towards the end of last year. And they were going through their business planning process, like many companies at that time of year. But what was unusual about what Spotify were doing is that they extended that time frame beyond a year to think about the next decade. Now, obviously, the further you extend the time frame, the less specific you can be. But what they wanted was to have a set of beliefs to guide how they would manage the business over the next decade. And what they said was, if you look at the past decade, so from 2015 to 2025, extrapolation would have worked. So, in 2015, the big platform companies were established. You went to Google for search, you went to Facebook for social, you hosted your services, your cloud computing infrastructure on Amazon Web Services. You distributed via mobile devices. For them, their biggest competitor was Apple Music. So what they're saying is, well, if you projected forward in 2015, it would have served you very well to just say, this landscape will persist. You can extrapolate what's happening here, and you should make decisions accordingly. Now, that was completely different from the decade before that. So from 2005 to 2015, if you were sitting down in 2005 to make your 10-year plan, then the critical things that happened over the next 10 years, you didn't know at that point. So the launch of the iPhone being the most obvious one, the move away from an internet-centric world to an app-based economy. Apple went from being a distributor to being a competitor. So there are all these things you didn't know that would be really important over that next decade, from 2005 to 2015. And so what I was saying was, you've been through a decade of where extrapolation worked, but you couldn't assume that anymore. So the next decade looks much more like 2005 to 2015 than it does from 2015 to 2025. And the reason that's the case is because AI is a completely new technology paradigm. It changes how services are delivered, how infrastructure is built. You can't just assume more of the same. You can't just assume that the winners keep on winning in the way that they did for the last decade.
Does that mean then, as an investor, Tom, you need to be more flexible, potentially, to the winners that could emerge out there, to the extent that you might not even have the winners emerging already? They might still tell to anticipate the next trillion-dollar company that comes out, whether it's from the US or China.
I think this is why it's really exciting time for growth investors, because when you go through these shifts, it just changes the scope of what's possible. So if you think about the past decade, past 20 years, we've had these companies grow that serve billions of people. So if you take Meta, which is the owner of Facebook and Instagram and WhatsApp, they serve 3 billion users every day. That sort of scale is unimaginable. And it certainly was not, if you go back a decade, that sort of scale didn't exist. But it's whether it's sharing social media posts or messaging, you touch a lot of people, but the value creation is relatively small for each one of those 3 billion people. Now, if you can have that same sort of distribution, but instead of delivering those services, you're delivering intelligence, the ability to help those people achieve their goals, what they're trying to do, you can create so much more value for them. So you've got that combination of huge distribution, but then the potential to achieve much more economically valuable tasks for that huge population. And so, I think that's incredibly exciting. But there is this question mark: do the incumbents manage to move through this technology shift? Because just about every other technology shift you can think of, we saw the creation of new big companies as a result. Now, so to make that more concrete, Microsoft became a huge company nearly 50 years ago now, through providing the operating system layer for the growth of the PC. We transitioned from mainframe computers to the PC, the portable computer, personal computer. And by providing the operating system for that, Microsoft became a huge company. You've had several platform shifts since: internet, mobile, cloud. The first two of those, Microsoft did not manage particularly well. It has managed the cloud transition well. But what you can observe is that it's been remarkably persistent. This huge business that's been able to sustain very high returns for nearly half a century. So I think when you get into these positions, the moat, the longevity can be enormous. And you've seen that with Apple, you've seen that with Google, you've seen that with Meta. In China, you've seen it with Tencent. So
you don't have any concerns, Tom, that's happened? Probably not more recently, but in the past few years around obviously Chinese corporate governance, transparency, state control, state interference, and so on as well. Obviously Jack Ma. Obviously it was anecdotal. He wasn't around for many months. He was disappeared. Do you have concerns around that still, or less so, I guess, now?
Well, I can almost link the two questions. So I think where you found these big franchises, they've proven pretty persistent beyond these paradigm shifts. But what's happened is that you've seen growth in adjacent areas. So when you had the growth of Google, it didn't destroy Microsoft, but Microsoft didn't benefit from the growth that came in search and so forth. It's remained a big company. But now, so going back to your China one, why have we been so interested in China? We've persistently had double-digit weighting in Chinese companies, despite the market going hot and cold, because it's the one place other than the west coast of the US where we've seen the growth of these big franchise businesses, persistent franchise businesses, able to take advantage of these technology trends and grow to very significant scale. Now, I think there certainly are risks about investing in Chinese companies from a governance standpoint and through the the idiosyncrasies of the jurisdiction. But I think that's true of everywhere else. You've been dealing with a very unpredictable political landscape in the US. And regardless of actually which party's been in power, it's only 5 years ago that you saw several Signature Bank or First Republic Bank in the US basically disappear because of government regulatory action that was unprecedented. And so I would not in any way diminish some of the governance challenges that you get in China, but I just think that I wouldn't downplay the ones that you get everywhere else. But I think those governance challenges are worth taking. If you can get strong alignment with the people running companies that you believe have a big long-term vision, that have the ability to execute at scale, they're invested in the same equity as you are, then we found that a reasonably reliable indicator that we can generate returns.
Would you think we'll win this AI arms race, Tom, between US and China, or is that the wrong question?
I think that different countries and the companies from the different countries have different strengths. And I think there's been a huge amount of creativity in the US in developing these large language models at extraordinarily high cost. If you look at the capital spending commitments of these large language model developers, if you look at the prices they charge, but they have been absolutely at the cutting edge. What the Chinese have been very good at doing is engineering costs out of these systems and delivering them at much more affordable levels. And I think both approaches can win. If you need absolutely frontier intelligence, because you're trying to make new scientific discoveries, or solve long-standing mathematical problems, or then you will use and pay for the cutting-edge models, which predominantly come from American vendors. But if you're trying to deliver a service to millions of people at very low cost, then the open source Chinese models look much more compelling. And certainly if you're one of the billion domestic consumers in China, or the next 2 or 3 billion consumers coming online in the global south, it seems much more likely that you will use these lower cost Chinese approaches than the cutting edge that you get in the US firms.
You recently wrote a paper, Tom, around how AI is not coming for your job, or jobs is coming for your mind, I found that really fascinating to read, around the whole kind of thinking, or people becoming potentially lazy or lazier and less productive going forward as well. Can you maybe talk to us more around that, and also how that could manifest itself in potential investment decision making of your own, and Baillie Gifford and your team and so on, as well as what investments you could be thinking about going forward to invest in based on that kind of thesis?
Yeah. So the paper, and your listeners can find it at scottishmortgage.com if they're interested, was not really about investment. What I observed is that there was there's a lot of discussion about what AI is going to do in society and what it's going to do for jobs, and whether it's going to lead to mass unemployment. And it just seemed to me that there's a lot of focus on that issue, but actually I don't really believe AI is going to destroy a lot of jobs. I think that it will create demand for more and more human workers in the future. Now, there may be a transition that's difficult, but I don't fundamentally believe it's a technology that's going to destroy jobs. But putting that to one side,
it might destroy some jobs, Tom, in some sectors.
Even
our sectors.
It will take over specific roles. But what I'm getting at is that I don't think there's some fixed amount of work to be done. That if humans do 100% of it today, and then at some point AI will do half of it, and we need half as many humans. Yeah. I just think that as we deploy these tools, the things that we're able to do, the services, the products that we're able to build, will just drive demand so much further. We'll need all the humans that we can get in conjunction with these AI tools to deliver that. But that's not really what the paper was about. What it was trying to say was, forget investment. What I'm observing is that if you look at the evidence, using these tools is changing what a human worker is. And there are ways that you can use these tools that will enhance you as a human, and there's a way that you can use them that will diminish what you're capable of. And the danger is that if we're not extremely deliberate about how we use these tools, then actually we're going to be giving away our cognitive ability. So it's not that our jobs will go; it's that we will have changed what the actual nature of a human worker is. What I mean by that is that all the neuroscience evidence suggests that if you outsource a task to an AI, then you will lose the ability over time. You will lose the ability to do that task. Now, a very superficial level, and this one for me, I've lived in Edinburgh for 30 odd years, and you tell me where you wanted to go in Edinburgh, and I could visualize where I wanted to go and go drive it. Today, I've got into the habit of just sticking the satellite navigation on anytime I go anywhere, just because I want to avoid the traffic. But as a consequence, you tell me anywhere in Edinburgh you want to go, I struggle now to visualize that skill that I once had, that brain development has gone because it's no longer needed. And I think that lazy use of AI does that in all sorts of other settings. So for example, if you get people to write an essay using search and write an essay using AI, what you will find is that recall of what the topic of the essay was, even a matter of minutes later, is completely, is completely diminished for the people who used AI versus the people who used even search or wrote the essay themselves. The mental difficulty, the actual challenge of it stimulates your brain. But if you just outsource it to an AI, the mental struggle does not exist. The brain development does not occur. You diminish what you're capable of. On the other hand, if you're doing the same piece of work, I write an essay on 16th century Britain. Now, AI could be a really useful tool. If instead of saying, AI, write me this essay, I go and ask it. This could be a fantastic tool for unearthing that information, having a ceaselessly patient companion that I can ask questions of, that I can debate things with, that I can really help me get to the bottom and understand things with. That's a purposeful use of the technology that enhances me as a human, that helps with brain development, helps with understanding. But all the evidence suggests that we're much more likely to do the lazy write me this essay, and I never. So it's really,
which is a worry, isn't it?
It's really saying
for humanity,
don't stop thinking, because I think whatever the job scenario is 10 years from now, is actually the people who can use their brains well will continue to be incredibly valuable. And one concrete suggestion, for example, is if you fly in an aeroplane. Autopilot could fly that aeroplane, start to finish, no problem. But we don't get pilots and say, press the autopilot button at the end. We train the pilots to deal, to fly that plane themselves, to deal with every eventuality, to really understand the job. And only after they've acquired all those skills can they use the autopilot.
Yeah.
And I think there's a real parallel to what we need to be doing. If we're training our accountants or our lawyers or our fund managers or our wealth managers.
Indeed.
That you've got to acquire those skills, and then once you have them, it's only then that you can maybe gain from actually using these tools.
It's an important point, like you said, Tom. It's better to acquire the skills or do it from first principles. I mean, even my son, who actually wants to do computer science as well at university, which I'm not sure is a good idea based on what's going on, but we'll see. He wrote an essay, I think it was March this year, that was going to go towards the exam, and I reviewed it, and it's clearly done through AI.
Yep.
Didn't done much effort at all. So going back to your point about being quite lazy about it, so I said, look, Yusuf, go on, do it again. This is not good enough. Think.
Yep.
You're 17. Start thinking. Think like you should be doing. Read books. Think. Don't just press a couple of prompts and get an essay out and try and pass it off as original.
Yes.
As a worry. Going forward, we see in our industry many times, Tom. People send us research notes, or LinkedIn is full of it.
Yep.
Where you get all these weird and wonderful knowledge pieces that clearly being AI slop, isn't it? It's called, and so on.
I think one way to conceptualize it is that AI is a force multiplier, if you like. And so, if you're, if you are, you work in professional services and you've got 20 or 30 years of experience, now you can use these tools to be massively more productive today. But you can only do that because you've got that existing experience. You know when to apply them, when to not. But if the people coming into the workforce who don't have that pre-existing experience, if they rely on the tools to do all of these things, they will never have the skills. They will never be valuable assets to employers. And so I think it's incumbent on those of us who, have those, have had that training, have had the benefit, of getting the productivity benefits that come from using these tools today, that we focus on how to bring that next generation through and ensure that they get the same benefits, rather than just being displaced because they never acquired the skills they need to add value over and above what the AI can do.
Yeah, no, it's very pertinent points going forward, Tom. Tom, just go back to the kind of investment side briefly as we nearly wrap up. I want to touch on Anthropic. You guys, clearly private investment, quite a hot investment. It's been in the news a lot in terms of its whether it's from a government political standpoint vis-a-vis the US government, as well as clearly from its revenue, annual recurring revenue generation. Firstly, why Anthropic as an investment as opposed to OpenAI in terms of significance around that? And again, I've seen some commentary about Anthropic potentially becoming one of the biggest companies in the world going forward, based on the whole replacement of some labour roles or productivity and so on as well. What's your kind of views on that and thinking around that? And clearly, you don't need to articulate this. It plans to go IPO pretty soon. Views on that? Could there be a position you may add to as well, or in that kind of space as well? What's your kind of thinking around that overall?
Well, I would tie it to one of the things you were talking about earlier about these big technology franchises and how they perform through paradigm shifts. And I think that incumbents can in certain circumstances do well, and in other circumstances can be challenged. But it would be a rare paradigm shift where big new companies were not created, native companies. It's when the internet came, Google didn't exist, but it wasn't any of the pre-existing companies that captured the search opportunity. It was Google. The same with social media. Google tried, for example, in that one to take that market, but it was Facebook that came through and seized that opportunity and became a big business in the process. And so one of the things we're thinking about is what are the companies that are going to succeed in this new paradigm? And that you touched on hardware. That may be a hardware company, and NVIDIA has certainly created a lot of value to date. It may be a data company. We own the likes of Databricks and Snowflake that are helping the enterprise organize their data for this opportunity. It may be in the model layer, and that's where Anthropic comes in, or we own Minimax, which is a Chinese intelligence model provider, or it may be in individual industries. It might be Aurora and self-driving trucks, which is a deployment of AI into a particular industry. So I don't know what who knows, but like trying to find the companies that have the potential to be create huge amounts of value through this period that we're going through. And so that's the context of the investment in Anthropic. Now, we've been a bit cautious on the providers of these models, and the reason is because they're very capital intensive to train these to build one of these systems, and then product differentiation historically has been quite limited. Do I use OpenAI's model? Do I use Anthropic's model? Do I use Google's model? Do I use Meta's? So why do we get the confidence to invest in an Anthropic? Well, one thing they've been very careful about is focusing on safety and being absolutely confident about how their model will behave before they release it to the public. And they also have had quite a different strategy in who they're trying to create this product for. So that whereas OpenAI sells ChatGPT, and that's predominantly been a consumer product, Anthropic's model has been predominantly an enterprise model. And so we thought, well, the combination of focusing on safety and being very cautious about what these services will do aligns very much with what the enterprise wants. If you're a big company implementing one of these systems, you don't want it doing all sorts of strange or behavior that you're not comfortable with. And so that focus on a specific segment with a product proposition that seems to align very well with that segment was why we were interested in Anthropic. And I think that you've seen the world come to them. As enterprises have started to spend on this, you've seen they've had this series of announcements of reaching these revenue milestones that have happened spectacularly quickly because you've seen the rapid adoption of this technology. And I think that they've said they've filed confidentially to move from being a private company to a public company. So others will get that opportunity to evaluate it at some point soon.
We're about to wrap up, Tom. Before we do so, for us at Binary Capital, for our listeners, viewers, for investors even, clients as well, what's one key takeaway you would tell us that we should look out for going forward in the future as an investor? What's one key takeaway that we should really carefully kind of hone in on going forward? From your perspective, what you're seeing, as you said, you travel a lot, you see this at cutting edge, you've met these entrepreneurs, you still do, these founders and so on.
I would say there's always reasons to worry, and the newspapers are full of stories about what's going wrong. There's lots of people that tell you why things aren't going to work. But from what I see, it's an incredibly exciting time. Yes, with any new technologies, that there are risks, but we see so many companies with huge opportunities in front of them. It's such a great time to be a growth investor. And it's, we've talked a lot about AI, and that's, that provides a lot of opportunities, but what's happening with the space economy, what's happening with the electrification of transport, they're introducing autonomy into all kinds of vehicles, new approaches to understanding disease and developing drugs. What I see is just such an exciting time to be a growth investor.
Tom, on that note, exciting time to be a growth investor, I can just say we've kind of run out of time. We probably I'm sure, half a dozen other points we could have covered, maybe for another time, but can I just say on behalf of me, Baillie Capital, our clients, our listeners, to thank you so much for your time. I know you're a busy guy, and it's been really insightful, interesting, and I'm sure we'll learn something for sure as we've spoken for the last hour. So I really appreciate your time, Tom. So thank you so much from all of us.
Well, thank you very much for having me. I'm delighted to be here and such interesting questions.